Happy Thursday, everyone. Today is a beautiful day in the Philadelphia area, which is great because it numbs a little bit of the pain of what happened last night to Chris and I's favorite basketball team, the 76ers.
Yeah, not a good showing. Not a good showing. We'll post it, but ESPN has that beautiful chart of the win probability percentage in the going into with a couple minutes left in the third quarter. It was 99.7% chance of the Sixers winning that game, and of course, as the Sixers and Philadelphia teams tend to do, they did not win that game.
Yeah, this one felt like one of the worst losses we've had in a while. Obviously, early 2000s Eagles. A lot of those losses come to mind, but this just felt because it's back-to-back double-digit blown leads, and this just felt like the entire process just died last night, and it's over. It's dead.
Can't trust this process anymore.
Nope, no more. So, yeah, not great. But other than that, let's get into the big news of the week. Obviously, we had the Fed decision. So, Chris, why don't you take us through that?
Sure. Not much different than what people were expecting. So Federal Reserve kept rates unchanged, kept asset purchases the same. So the big news, if there was considered big news, was that 13 of the 18 officials indicated in the dot plot that they expect to lift short-term rates by the end of 2023. And that's up from 7 back in March. And then 11 of the 18 saw at least 2 rate hikes by the end of 2023. And 7 saw a move as early as 2022. So that's up from 4. So that's the big news. It was a little bit more hawkish than people were expecting. So interest rates are going to increase faster than, or Federal Reserve officials are expecting interest rates to increase faster than maybe what they were expecting in March. To me, the dot plot is the dumbest thing that the Federal Reserve has ever put into place because it honestly means nothing. I mean, we're doing these dot plots in March, and people are doing these projections based on where we are in March. Things have moved better than expected, so it would be expected that the dot plot would change for interest rates moving up faster than expected. So to me, I don't see the big news. Obviously, it means a lot. It could mean a lot for the markets. Obviously, it's a discounting mechanism, discounting machine. So higher interest rates mean lower prices, et cetera. And it is what it is. So they also revised the GDP expectations up from 6.5% to 7% for 2021. So that's good. So obviously, we're growing faster than expected. And they continue to talk about how inflation is going to be transitory. So it's just going to be here for a brief second, then leave. So that'll obviously come down with employment. That'll come down as the unemployment benefits kind of drift away, and people are kind of forced to go back to work because they're not getting paid as much, just receiving unemployment benefits. One of the things we'll talk about as well is student loan payments are going to pick back up for a lot of people. So it's going to be a lot less money that people have. So that inflation number should really come back down. So they're expecting inflation to be 3.4% for 2021. And that's higher than what they were projecting in March at 2.4%. But again, everything's better than expected from March. So we'd expect these numbers to be a little bit higher.
Yeah. And, one thing that was going through my head, we were watching, Powell talk yesterday is, obviously watching the Fed is something that advisors and investors should do, right? You want to pay attention. You want to know what interest rates are because they do have an impact on obviously earnings, right? Pricing, like you said. But if you're a long-term investor, right, and you think over 5-10 year periods, like what happened yesterday, it's inconsequential, right? It's things like that, we're being super concerned about, what's the Fed chair going to say tomorrow? It's not a way to think in the long term, right? Like obviously, yes, interest rates matter, but at the end of the day, if you stick to a long-term plan, like I said, these Fed decisions don't mean much.
Right. It goes just back to the chasm between investing and trading, right? So
yeah,
if you're trading, they mean something on the day-to-day. That's how you make your money. If you're investing over the long term, there's going to be periods of high interest rates. There's going to be a period of low interest rates. There's going to
be a couple more recessions. It's going to happen.
good Fed decisions, bad Fed decisions, but over the long term, that's really why you're investing, to kind of see yourself through all of those different time periods, and making any kind of decisions based off of, a Fed decision, or because you think inflation is going to be a little bit higher, over certain time periods, may or may not make sense. But over the long term, generally, it's been more beneficial to, stick to what your long term goals and objectives are and focus on those.
Yep. Yeah. And I guess kind of on the topic of investing, our next discussion point is I saw an article yesterday, and it's something that I've seen a lot and people are talking about, right? And it's kind of what's called the death of the 60-40 portfolio, right? And what is the 60-40 portfolio? Obviously, it's 60% equities, 40% bonds, right? With the idea that the equities provide enough upside and the bonds provide the income and some downside protection when the market moves. Unfortunately, the reason that they aren't sustainable anymore over the long term, interest rates, right? Because the yields on, the 10-year yields 1.5% and moved up yesterday, right? I mean, you're just not getting you're not getting the yield that you used to. I did see in the article that I read, so the 10-year treasury in 1981 was 15.884% compared to 1.5% today.
Right.
Like in the 80s, yeah, 40% of your portfolio is yielding that. That's great, right?
What was the mortgage rate back then?
16, 17, 18%, right? So like, yeah, it's a trade-off. That's the trade-off, right? So it cost a lot to borrow money back then. But yeah, you were getting guaranteed, by the government, returns on your fixed income, which is great.
Yeah.
That's not happening. 15, I mean, you can never say never, but in our lifetime, I don't think we'll ever get back to 15.8%. I don't see that happening.
Unless we get some crazy runaway inflation that
right.
hasn't occurred for years,
right.
then I doubt that.
Yeah. And then, so in the article, so Dr. Kelly, he's the global strategist for JP Morgan. He mentioned that he would expect a 60-40 portfolio to yield an annual return of 4.2% over the next 10 to 15 years, which isn't really good enough. And the reason being is that's not counting inflation. So let's just for the sake of today, we'll call inflation 2%, even though we know it could be higher, right? There's a good chance inflation is higher. So your real return on that portfolio is 2.2%, right? But as we all know, the 4% rule, right, where you need to withdraw 4% a year, right, in order to live off of your assets, that's not going to last over a long time period. Unfortunately, you're going to withdraw your money. There's going to be too many outflows, not enough gains to offset inflation and withdrawals. That's the two things you have to offset in retirement.
Right. Yeah. There's a couple problems here. So one is, like you said, fixed income being included in people's portfolio generally served a couple purposes. You hit on one, right? To lower the volatility, the ups and downs that the portfolio is going to see over time. And then the second one was to provide income, right? So right now, fixed income is really only doing one thing, and that's just to lower the volatility of the portfolio. But people can't eat risk-adjusted returns, right? So that doesn't mean a ton if at the end of the day you need to take money out. So you're not getting any return from those. So that really hurts, like you said, the 4% rule. So what we're seeing and what we've been doing for a long time, but what we're seeing a lot of investors and companies do is kind of move towards a hedged equity approach, right? They're going to take on, do some things that provide upside, but also provide downside protection. So whether that be structured notes or kind of option writing things, hedged equity type products, or they might move into different areas of fixed income that maybe provide a little bit more yield. So obviously take on more risk within fixed income. It's not always just I have to invest in U.S. treasuries, right? There's emerging market debt, there's high yield, there's these other different things. Yeah. So expanding that 60-40 portfolio to be a little bit more diverse, I think is going to help people over the long run. Yeah. And then, another thing that's you always have to think about too is just when you're retiring. Unfortunately, there's not much you can do about market returns when you retire, but one of the worst things to happen to people, you can be completely set for retirement and then retire, and then the market has a terrible 10 years, think maybe like 2000 to 2010, where basically the markets return nothing, but you're taking money out of your portfolio that entire time. And while the market's declining, and then you have less money when the market starts going back up. So it really just reduces the time frame that you're going to have all of that money available over retirement. So it can really shorten that time period. So the 4% rule might be good, might not be good, depending on. Also, you could start an amazing time. So you start the lows of, or in the bull market of the 1980s, you could retire right before that starts and be taking money out a lot more than 4%, and that takes you a lot further than you would have ever expected. Right. So the timing aspect is always going to be really hard to project, but moving forward, that 4.2% that he talks about is indicative of the returns that we've already seen. A lot of the returns, a lot of people think have gotten pulled forward, where we're not going to get 15% annualized returns for the next 10 years on the S&P like we saw over the last 10 years, right?
Yeah. Yeah, and I think another thing too is just going for broad diversification in your equity, right? And that, which is easy to do now with ETFs and mutual funds and just baskets of stocks, right? Just getting lowering your risk by just getting more and more diversified in the equity portion.
Right. And I guess a final thing would be to think about if does the 60-40 even make sense anymore? Like, so we say 60-40 because it's the quintessential model that basically you can almost fit 80% of people into, that you're going to be managing their wealth. You're not talking about the 30 to 20-year-olds, and you're not talking about, the 110-year-olds, right? You're talking about the majority of the people that probably want to, participate in gains, but take less risk. Does that even make sense anymore? People are living longer. Do you really need 40% of fixed income in your portfolio, or what is the right amount? So really speaking to an advisor and kind of gauging that is going to be pretty crucial. People are retiring at 60, and you have to plan for another 30 years of retirement or taking withdrawals. And that's a long time period to, worry about.
That's a long-term investor. Yeah.
Exactly. That's a long-term investor. So you have to think like a long-term investor, even when you're retiring. So just another thing to talk about with your advisor, or think about when you're kind of allocating that portfolio.
Yeah, and I think just people are kind of stuck in their ways with that. That's kind of an old school way of thinking. Is I have to get more conservative when I get towards retirement. Yeah, that was when people were dying in their 70s, right? People people are living longer and longer. Obviously, last year was a blip, but I think people in general, as healthcare evolves, right, and just people are just more conscious of their health, right, and know things. People are just going to live longer and longer. It's just what's going to happen. So. Yeah. All right. Well, next topic, we mentioned it earlier. Let's talk about student loans. The crazy amount of student loans that we have.
This student loans, you come across these articles, and it's funny that Wall Street Journal and Bloomberg both had articles about this almost back-to-back days. It still boggles the brain at the amount of student loans that are out there and the amount of debt that some people are strapped with. So we'll post a few pictures as we talk about them. But basically, some of the stats here are, like I said, crazy. So more than 40 million holders of federal student loans are going to. So this isn't that crazy. This isn't really a stat, but this is just basically saying that student loans, people are going to have to start paying their student loans on October 1st again. So as everyone knows or should know, is that if you had federal student loans, they basically suspended payments for basically since COVID started. So last year you haven't had to make a payment, and anything that you did pay down was just paying down the principal. So it was basically 0% interest loan. So that's going to end if they don't do anything. The end of September. So you're gonna have to start making payments in beginning of October. So the crazy stats are Americans right now owe 1.7 trillion with a T dollars of student loan debt. So that's twice the size of credit cards, right? Twice the size of credit card debt.
That's 1,700 billion.
It is a crazy amount of money, how much people owe. So let's see what else. So before the pandemic, Americans weren't paying off their student loan debt obligations. Loans in serious delinquency, so more than 90 days late, exceeded $135 billion before the freeze. So that's almost 8.8% of all the student loans by the end of March were basically weren't being repaid, so delinquent. So we'll post a picture of that as well. The number of people, let me see this. So I didn't even realize this, but the number of borrowers that are 62 and older
Yeah.
has increased almost 40%. And the amount of debt that they actually owe has increased 80%. So you have people that are 62 and getting ready to retire, and they have student loans, or whether it be that they took them out themselves or their co-signer for their kids have student loan that they're required to pay back in excess of $200,000.
Yeah.
I mean, it's absolutely nuts. The amount of debt that people aged 50 to 61 and 62 and older, you can see in this chart, has grown substantially over the years, while 40, 24 and younger, and the people that you would expect to have the student loan debt has actually decreased. So it's pretty interesting to see like where the student loan debt is really growing and kind of
when you showed me, when you showed me this chart with people 62 and older, that I immediately was confused how that comes to be. Whether, my first instinct was maybe people just don't pay them off. They pay the minimum. They just keep pushing them out. You had mentioned maybe people are going to school later. That's another probability. And or like you just said, co-signing with their children.
Yeah, it's so this other chart that we'll post shows the breakout of the student loans by the amount of debt that people actually hold. So whether it's 5,000 to 10,000, 10,000 to 20,000, the biggest proportion of this is people that are holding over $200,000 in student loan debt. $200,000 is a lot of money. It is wild to me.
Wow.
This many people that have $200,000 in student loan debt. It's nuts.
Yeah, and they can't all be doctors and lawyers. I mean, because I imagine doctors usually carry, a high amount of debt. It does cost a lot to go to medical school, but they typically make up for it on their income after 10, 15 years. But yeah, it's crazy.
Yeah. So one of the things that we were talking about when we were talking about the Fed, right, was that I think there's going to be a lot less spending in the coming months, that when people have to start actually repaying some of this stuff, student loans are going to kick back in, right? All of a sudden, now you still have that extra payment. If you're unemployed, you were pretty happy that you didn't have to pay the student loans, but now you're getting an extra $300 less when that Federal Reserve or the federal assistance kind of leaves, and then you're paying your student loans on top of that. So I think that there'll be a lot more saving. We're not going to see as much kind of money velocity moving back. You're right there.
Yeah, good. I had a pop up.
So we're not going to see that money moving as much back and forth with the student loan. So they were also talking about, right, forgiving $10,000. I mean, some people like Elizabeth Warren were talking about $50,000. I don't think that's going to happen. I don't know how they would do that. I think it's possible. I mean, I wouldn't, with the interest, if your interest rate's still pretty low on your student loans, I wouldn't rush to, if you have a reasonable interest rate, I wouldn't rush to, pay them off if you're having trouble paying them off. But, so I do think that there's a chance, but, what's $10,000 and $50,000 they're talking about forgiving when these people owe $200,000. It's crazy.
Yeah. Yeah. I mean, and it's going to be a good study maybe in a few years when we can kind of look back and see what did spending look like when these loans were in forbearance, right? When they were put off for a year and a half, is that worth doing some kind of student loan forgiveness to promote spending, right? Because who spends a lot of money? Younger people, right? Younger people in lower incomes. So when a large amount of your monthly income from work is going towards student loans, that's less money going into the economy, right? It's just money going back to the government.
What do you think about, so I wonder how much of this contributes to the kind of housing boom that we've seen. So all these, before this, everyone was talking about millennials aren't going to buy houses because that's not what millennials do. But then it turns out, millennials are like every other generation. They want to live in a house at some point. And then all of a sudden, student loans, they don't have to pay their student loans anymore. So it's like, well, I got
extra $500-600 a month.
Yeah, maybe I'll buy a house, and then it will be interesting to see like kind of how this stuff plays out down the road once these student loans pick back up. I mean,
I think we're going to learn a lot in the fourth quarter fourth quarter of this year, first quarter of next year, because like you said, October 1st it starts again. It's mind boggling. It's really, 1.7 trillion is, I don't think people quite understand. I mean, when it comes to trillions, it's just, it's crazy. And, I mean, and people are still carrying, they still come with interest, 4, 5, 6% interest. It's like, not like, it's not low interest on the,
Yeah.
it's not like a mortgage. It's not like, it's higher. It's crazy. So, I mean, that's one thing I've seen is maybe instead of forgiving student loans, right, doing any kind of loan forgiveness, why charge a lower interest rate or no interest rate, right? Why does the government have to profit off of, these, like, I get like that's just, you borrow money, you pay it back with interest, but like, can we lower it at least?
Yeah, well, we'll have to.
Yeah,
One thing that we were talking about with that number,
they're never going to pay their student loans off.
right? We were even talking about.
Mhm.
I'm sure that's all student loan debt, but we weren't even sure.
Right.
It was just
If they
that
count.
people still have private. I still have private student loans, so
Right.
I've been paying those off the entire, pandemic. So they didn't get canceled either. So that so people are still paying those off, and those are just stats and pictures on the federal side.
Yeah, I know it's crazy. So, all right, well, moving on. So, this week's financial planning topic I kind of wanted to briefly talk about is gifting, and the reason being is I've had a few clients kind of ask me about that, and it's been in the news that the annual exemption could come down, right? So it's currently sitting at about 11.7 million. So it's like 23.4 if you're married, right? Incredibly high number. Not a lot of people are going to be worried about that, right? They're not going to owe estate taxes. There's been talks that it could come down to 3.5 million per person, right? Or 7 million for a married couple. So if you're single, a lot more people then are going to be subject to estate taxes, right? So people are kind of asking me about gifting, right? Now, a gift is basically any, sort of just, I'm giving you, right? It can be cash, you can gift securities, you can gift property, whatever it is. So what is the annual gift exemption? It's currently $15,000 per person, right? That you give to. So if you're a married couple, you can give 30, right? So let's say I have 3 children, I can give $45,000 total, right? 15, 15, and 15. Or if I'm married, 90,000 total. And a lot of people, what they ask is, all right, so if I give $16,000, do I owe tax that year? No, not necessarily. When you give over the annual exemption, it just means that you then have to file a gift term or tax, and that amount, right, eats into your annual or your lifetime exemption, that 11.7 million. So it's something that I kind of want to clear up, and I think it's going to be a very prominent estate planning tactic moving forward if these exemptions come down. Because if you think about it, if you're wealthy, you have money, and you're going to give it to your kids anyway, right? It's going to go to your kids, it's going to go to your grandchildren, whatever. Rather than a large portion of your estate being subject to the 40% estate tax, right? Just start giving the money to them, right? Accelerate the gifting, get it to them earlier. You can do $15,000 per child, right? 30,000 if you're married. And there's a thing called for 529 plans for you, out there that have grandchildren or even children, right? For 529 plans, you can give $150,000 at once, right? Without eating into your annual or your lifetime exemption, in what's called like the 5-year acceleration, right? So, I mean, that's crazy if you're married. So that's $75,000 if you're single, $150,000 if you're married, because it's 5 years accelerated. So I think that for wealthy people, developing some kind of a gifting strategy is going to be a pretty important thing going forward, right? You're just sort of accelerating what's already going to happen. Your kids are already going to get the money. So why subject them to 40% estate taxes? Start giving the money now, right? Start giving in your 60s, start then, right? Keep going and give every year, give to your grandchildren, put in 529s, whatever it is.
And it might help with the student loan debt.
Loan debt, right? So yeah. All right. Well,
is there recommend, like, would you prefer people gift highly appreciated stock or cash?
Well, I mean, if you have highly appreciated stock, it's the best thing to get, right? Because you're doing 2 things. One, you're removing assets out of your estate that were going to come out of your estate anyway. And 2, you're going to reduce your capital gains exposure, right? So if I have Apple, right, and I have, $15,000 worth of gains on it or whatever it is, $5,000 worth of gains, let's say, and it's $15,000 position. Rather than sell that and pay the capital gains on that $5,000 gain, right? Just gift the stock to them, right? Open a custodial account and give them the stock. You avoid the capital gains. They get carryover, but they're younger. They don't have to worry about it. And then, if and when, I think that's definitely appreciate stocks, one of the best things you can get.
Right.
Appreciate property in general. Right. So yeah, I think, if you are wealthy, I think it's important to talk to, a financial planner, an estate attorney, about developing some kind of gifting strategy. I know we're pushing a lot of our, more wealthy clients to start doing that now.
And just we like to always think too, from the behavioral side, right? A lot of people will tell you that if you're going to leave your kids money after you pass away, why not just do it now? Why you could actually see them receive it, get the joy that they might get from it, do something for them while you're around so that they can really appreciate you, and you can appreciate them appreciating it. Instead of,
this get a good idea of how they're going to spend it and what they're going to do with it. And maybe, it changes your mind on who you want to give it to.
Yeah, exactly.
If I'm blowing Vegas one weekend, you might go, maybe you're credit out of the bill.
Yeah, maybe we'll figure something trust out for you or something.
Yeah, exactly. So, all right. Well, other than that, we have the US Open this weekend. It's actually currently going on right now. I don't know who's leading, but I do know the favorite going into the weekend was Jon Rahm, which we talked about yesterday. It was pretty interesting because Chris didn't know this. The guy's never won a major.
You're right. I thought I could have sworn that he has because
he's great
world rankings.
Yeah, he's never won a major. So, and I did bring up, does it have anything to do with last week, him getting DQ'd? Is it kind of like a lot of people betting on him? He is top 5 in the world right now in the PGA standings. So yeah, he's a great golfer. So we'll keep an eye out. Who do you got? What's your prediction? Anyone you're rooting for?
Well, I know that, I'm not gonna give away your pick, but I'm always rooting for the young guy. So I like Justin Thomas. I think he's finished pretty well the past couple opens.
He's always up there, but he seems to have some issues. It's like another one with that Jordan Spieth, right, where everyone was happy that he won. So because he always loses, he always comes close and doesn't finish. So yeah, I think people do like JT.
Yeah, he hasn't been playing great, but I looked at his past couple open finishes and he's done okay. So maybe this is the one. But I'm always rooting for them. I go JT.
Yeah, me, obviously, I'm a big Brooks Koepka fan. Love Brooks. He dominated 27. I think he won 2017, 2018, came second in 2019. And then my second is, I like Max Homa. I like him on Twitter a lot. He's funny on Twitter. He goes at people. It'd be cool to see him win. He hasn't won any majors either. So, it's another young guy. That Will Zalatoris from he got famous from the Masters. That guy that looks like, the caddy from Happy Gilmore.
Yeah.
He's a good one to root for too. But yeah, it's going to be fun. Looks like it's going to be a beautiful weekend. Maybe everyone else can get out and play some golf themselves, then watch some US Open on Saturday and Sunday.
Rough looks thick over there, though.
Oh yeah, I would lose 100 balls.
Easily.
100. Yeah. So, all right, everyone. Well, I appreciate you guys tuning in. Again, if you like our videos, we're trying to do these every week. Please like, subscribe, and everyone have a great weekend.
Great talking to you.